So let's look again at the actual income statement and actual balance sheet examples that we spoke about in the two previous sections. And what we'll do is we'll create the cash flow statement from scratch. So all you need is the income statement and the balance sheet to create a cash flow statement. It's really easy. So before we do, I want to take a quick look at the three sections of a cash flow statement. So there's three parts. Part one is cash flow from operations, meaning cash that you made from operating your company. Part two is cash from investing, okay? Meaning long-term assets, right? Like machines or land has to be accounted for. And part three is cash flow from financing, meaning from debt or changes in common stock. So if we get a loan, then that means our cash flow from financing, which is the third part of the cash flow statement, goes up. Okay, let's kick it off with cash flow from operations now. So as you can see, you've got our net income there, which is $375,000 or so. Step one, you get your net income, okay? Step two, you add back all the non-cash items on your income statement, okay? So in this case, it's depreciation and amortization. It's a non-cash expense, okay? Then what you do in step three is you then look at the balance sheet, which is right here. And what you're going to do is add or subtract items that are current assets or current liabilities that are non-cash. And recall that anything that's a current asset or a current liability means that those are due or can be turned into cash within 1 year. Okay, long term is greater than 1 year. We're just looking at short term. Okay, so what we do is we add back the change in accounts payable. Accounts payable went up, right? So we owe someone money. That's money in our pocket still, right? It's money in our pocket. Not saying it's a good thing that we owe someone money or paying back items late, but it's cash in our pocket, and that's all we care about, okay? And accounts receivable went up as well. So one of our customers owes us money still for a contract that we signed. They gave us a post-dated check. As a result, we're going to get hit on that cash temporarily. We'll get it later, but it's going to hurt our cash flow statement. Cash will go down. And the same thing goes with inventory. If you build up too much inventory, what happens is it hurts your cash flow. And companies that tend to overbuild or create too much inventory can go bankrupt quite quickly, okay? And so if we look at the change in net income plus all the balance sheet items we added back and all the non-cash items on the income statement, we get a change here of $310,750. So our cash flow from operations is $310,750. But that doesn't explain the change in cash, remember, from the balance sheet, which was $200,000. Let's drill down a little bit more, okay? So let's now look at the second of three components of the cash flow statement, which is cash flow from investing, okay? So what we do is we look at our balance sheet, and we invested in land and machinery and other items, okay? So that's 60 grand out of our pocket, right? That's where our cash flow from operations is. So far, we have $310,750 positive from cash flow from operations. We also have $60,000 negative from cash flow from investing. Now we have to talk about the third and final component of the cash flow statement called cash flow from financing. So we can see here our loans and other items have actually made a change in cash flow from financing, which results in negative $50,750. And we get it right from the balance sheet, from the current section. Now, if we add up all three of those items, cash flow from operations, plus cash flow from investing, plus cash flow from financing, we get $200,000. Okay, and that's the change, remember, we saw on our balance sheet from cash from 1 year to the next. Okay? So now you understand how to reconcile the difference between net income and cash. Now let's talk about how all three financial statements are related. Well, we know that the balance sheet basically shows you what you own or who owns your stuff, and it always has to be in balance. The income statement basically tells you how much revenue you're generating and what your expenses are. But remember, the income statement is not accurate. I like to say the income statement is a lie. And so we need a cash flow statement to tell us what our change in cash is from one accounting period to the next. So how are all three statements related? And this is a beautiful thing because you can check to see if you made mistakes on your three financial statements by looking at the following relationships. So on one side, you have the balance sheet, then the income statement in the middle, and the other side, you've got the cash flow statement. And the way that the balance sheet and income statement are related is you look at net income, which is at the bottom of the income statement, and it actually is equal to the change in retained earnings, right, from one year to the next. And that's part of the equity section, which we covered in the balance sheet section of this course. Next up, we've got the relationship between the income statement and the cash flow statement. And you take net income, which is at the bottom of your income statement, and you'll see it's at the top of your cash flow statement. You always start with net income because you then add back or subtract cash and non-cash expenses, as we talked about. And the last relationship we've got is between the balance sheet and the cash flow statement. How? Well, the change in cash from one year to the next at the top there of the balance sheet is equal to the change in cash that we derived from the cash flow statement. Now, what can we do? Well, now that we understand the three financial statements and how they're linked together, what we can do is we can predict the future, which we'll do in the financial modeling section of this course.